What's going on? Just a quick little video on swing trading for you, Drake, and anyone else who has any questions. With swing trading, what I'm going to do is I'm going to use my big chart here. The reason why I use the big chart with all the moving averages on it for swing trading or kind of giving a macro overview is because I want to know where the hell we have opportunity to run, and I want to know where the hell we have opportunity for, potential stop loss. So, for example, let's take a look at Apple, right? Because I'm already using this as an example in chat. If we take a look at Apple, okay, once we lost, well, we got to go all the way back, right? So every time that we lose the 5-day moving average, which is the green line here, every time we lose the 5-day moving average and we confirm lower, we normally go lower prices, right? So when we look at this from a macro overview, here's the macro overview, right? This is the macro picture here. If a stock or index is below its 50-day moving average, it's a short position, right? If a stock is underneath its 200-day moving average, it's a short position. So, what does that mean? Let's look at the last time Apple lost the 50-day moving average. 50-day moving average is the red line on my screen. 50-day moving average is right here. This was on 4/14. We lost it at a price of $165. Now, the last time we reclaimed the 50-day moving average was here on the 4th. So almost 3 weeks later. However, I would have not stopped out of this position because there was no confirmation of a follow through over the 50-day moving average. So we still hold this position. Now, if this day confirmed the price here, I'd have to get out and take a small loss. Again, we would have entered into a macro short position on Apple. And anytime you're going to do a swing position like this on a macro play, you always want to go 1 to 2 months out on your contracts, at least 1 month. If we would have taken 1 month expirations on Apple from here at 421, then on 521 we would have sold. Let's just go to a date of 521. 521 was here, right here. So you could have essentially sold Apple down at the bottom at 132. We entered into Apple at 164. That's a 30-point move in 1 month on Apple. Now, if we're going to have some sort of dead cat rally bounce, any kind of bounce, here's what we're looking at. We can play the moving averages. You're going to give yourself more room to work, and you're going to be working off the daily time frame. You're going to be using daily levels. So if the green line is the 5-day moving average, we just reclaimed the 5-day moving average on 525. We also reclaimed the 5-day moving average on 523, but there's no entry on 523 because on 524 we did not confirm the highs. If we confirmed the highs, I would have started a swing position. So 525, we closed over the highs. Yesterday, we confirmed those highs, and that confirmation was 141.67. So we would have started a swing position on Apple yesterday over the highs, over the 5-day moving average, and that price closed yesterday at 144. So let's say you missed that play. Well, what's the next level of supply? The 10-day moving average. That's the blue line. So you could have taken a close over the blue line, which is a 10-day moving average. That price is 144.38, and today we obviously gapped over that, so you could have started a position. Now, what's your stop loss? Well, if you're going to use the 10-day moving average to start your swing, then the 10-day moving average is your stop loss. If you got in here on 526 because you're using 525's close over the 5-day moving average as your starter position, then what's your stop loss on that? It closed underneath the 5-day moving average. So as long as these moving averages continue to stay below your entry price and the candles stay above, you continue to hold a swing. Now that we are over the 20-day moving average, which is the purple line on my screen, that price is 149.91. You could have essentially got in over the 5, ridden it all the way to here, and you would have made from 142 to 149, 7 points on that move. Could have sold out today. Now, here's the thing with swing trading. When do you sell? Whenever the hell you want to sell. You could have sold yesterday if you entered the day before. If you entered in yesterday, you could have sold sometime today. If you just entered yesterday and you're still holding today, you can hold this into next week. What's the next level of supply? That's the linear regression channel 50. That supply zone is 154.45. Now, if you just want to use the 20-day moving average now as your stop, then you would use a close under 148.25. You would just get out. I really wouldn't start shorting Apple until it loses a 5 and 10-day moving average, and currently right now that price is 142.83. So think about it like that. We're going to go from supply to 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 all-time highs. We're going to go from demand to the bottom channels, demand to new lows, to new lows, to new lows, to new lows. That's how you swing trade. Just understand when you're swing trading, especially in a volatile market, you're giving yourself 2, 3, 4 points worth of risk on these trades, and you need to let them work. As long as it's over your supply level or your demand levels entry, you're going to hold the trade. Meaning that we closed over the 5-day moving average, next day we confirm it, I'm in. Missed that trade, we closed over the 10-day moving average, we gapped over today, we confirmed the price of the entry over the 10-day moving average, I'm in. Could have sold today, could have sold yesterday, whenever. It all depends on what you're looking to do and how long you're looking to hold it. Now, if you want to get into a super long swing trade, well, then you just pretty much tell yourself, as long as we hold, the 5 and 10-day moving average, you're going to stay in this trade. So right now, Apple's just considered a long until it loses the 5 and 10-day moving average. If it loses 142.83, you got to get out of the trade. But as long as it's over 142, 143, you're going to stay in the trade, and then let it try to work to 153, and then let it work to 156, and let it work to 160. So it all depends on what your risk tolerance is.